why don't you walk us through this chart here? Because everybody's wondering what's happening with the markets given the war, given interest rate hikes, and the repricing of stocks. I don't know how you would look at what happened in November, December, January. Brad, how do you contextualize?
Well, it's certainly a repricing. It's certainly a repricing, but I think of it more as normalization.
Okay.
Right. Chamath was saying it in November. I was on CNBC talking about the fact that when we got to a post-COVID world, rates were going to normalize, go back to where they were in January 2020. That was around 2%. And that growth multiples would have to come off of this historic Red Bull high that we were on during most of 2020 and 2021. So we were 30 to 50%, depending upon the index, above the 5-year average growth multiple pre-COVID. So that just needed to happen. Like, we should be celebrating in one sense that happened, because that means that we overcame a global pandemic. The downside is we couldn't play with artificial money, 0% rates, trillions of dollars, of congressional and Fed injection in order to prop up valuations. And when it happened, in and of itself, that was going to be extraordinarily painful. What I didn't anticipate, and what most people didn't anticipate, is that on top of that, we're going to have increasing fears of hyperinflation, not just getting back to normal rates, and that we were going to find ourselves in the middle of an incredibly devastating war in Ukraine. Those two things added to the uncertainty, the risk premiums, added to uncertainty around future inflation. The dot plot exploded higher, and expectations of forward rates went higher. Now, why the hell does this matter? It matters because when you take, if you're looking at that chart, the 5-year average, the 10-year was 2.5%. Like, we all got comfortable investing in this period of time. The markets hate uncertainty. We had a predictable way for us to estimate where we thought our WACC should be in our discounted cash flow models. All of a sudden, that was thrown into the air. Oh my God! Look what we got going on. I can't compete with that.
Look at this.
Oh yeah, never compete with babies or animals.
No chance.
No chance. Hey,
this is Talita.
Talita.
Look at this little butterball.
Oh my goodness,
Lord! Look at that.
So good.
Sax, that's called a child. It's you have 3 of them. Those are babies, and what you're seeing there is affection from a father and a child.
Look at how cute this little baby is. I'm just going to eat.
Sax is like, well, this is taken from my time. Get that baby out of here.
Wow.
So cute. So, Brad, I guess what everybody wants to know now that we see this repricing occur is, what do you think is going to happen in 2022 and then into 2023?
So multiples are now below the 5-year average. For software, we're about at the 5-year average. For internet, we're well below the 5-year average. I said on Twitter that the rate path last week became a lot more certain. The Fed said something last week that I think is still not well reported, well understood. The Fed said at the end of the year, we're going to have 2% negative real rates. They said we expect inflation exiting the year to be 4.3, and we expect the 10-year to be around 2.3. The reason the market exploded higher is because under the Fed's prior protocol, a 4% inflationary rate would mean that rates would have to go to 4.5. And if you take rates to 4.5, then growth multiples need to be about 30% below the 5-year average. Okay. So as investors, whether we're investing in mid-stage venture, late-stage venture, whether we're investing in the public markets, we need to know what exit multiples are. And it was bad enough that we had to bear the drawdown coming off of, this Red Bull high of 2020 and 21. But if you think we're durably going to an inflation rate of 3% or 4% and an interest rate environment of 3% or 4%, then you simply have to adjust what you're willing to pay for growth assets. And so as I look ahead, right, we don't know with certainty. The question is, what's the distribution of probabilities? And just this morning, Citi, Goldman Sachs raised their exit 10-year for 2022 to 2.7% and took it as high as 3.5% for 2023. I think this period is going to be marked by a lot of uncertainty around inflation and rates till we have more clarity. And what that means is allocators of capital are going to allocate less to risk assets, and they're going to pay less for risk assets. But, listen, if I look out over the 5-10 year horizon, I don't believe in global stagflation. I don't believe that we're in this new hyperinflation environment. But we're going to have to get through this next 6, 12, 18 months, and it's going to be filled with a lot of volatility and a lot of uncertainty.